Options trading can feel exciting until you realize how easy it is to lose money if you don't understand the risks. But here's the good news. Risk doesn't have to mean danger. It just means uncertainty. And today I'll show you how to understand that uncertainty and manage it, even use it to your advantage. Plus, I'll walk you through one of the safest trades a beginner can make, a cash secured put on a stock or ETF you actually want to own. Let's start with the basics. Buying options might seem safe because the risk is limited to the premium you pay. But here's the problem. If the trade doesn't go your way before expiration, you can lose 100% of your small investment. That happens more often than new traders expect. These trades can be cheap, but the cheap ones are also low probability, and they expire fast. So you have to be right about your predictions to make money with them. Now, let's talk about spreads, often pitched as safer strategies because they have defined risk. And they do, but again, if the trade moves against you, you can lose the entire width of the spread, minus whatever premium you collected. And if you try to repair the position by widening the spread, you've actually increased your capital at risk. That's something beginners often miss. Repairs can be smart, but they're not always a lifeline. They come with trade-offs. People who buy options and trade spreads are often risking a large percentage of a small account. A few hit a home run, but many strike out. Hoping your wins will make up for your expected losses is more like gambling than investing. So, what is the safest option strategy for beginners? Two in particular stand out: cash secured puts on a stock or ETF that you want to buy, and covered calls on shares you already own. Both let you generate income up front, and both involve companies or ETFs you'd be happy to hold in your portfolio. Let me show you what this looks like in a real trade. I'm going to sell a cash secured put on Coca-Cola. I'm choosing a strike price of $70, which is below the current share price. That means I'm agreeing to buy 100 shares at that price if it drops. With Coca-Cola trading at $70.39 a share, I'm going to sell a cash secured put with a strike price of $70 that expires in 20 days. The order filled at 94 cents a share, or $94 total, less a 66-cent trading fee. $93.34 cash came into my account, and I'm securing the put with $7,000 of cash collateral. On a 20-day trade, that translates to a 24.34% annualized return. On April 17th, when this contract expires, one of two things will happen. Either the share price will be below $70 and the shares will be assigned to me. For example, if the share price is $69, I will be assigned to buy 100 shares of Coca-Cola stock and I will pay $7,000 for them. But if the share price is above $70, I will not buy any shares. The contract will expire worthless and I will just set up another trade. The benefit of selling the put is that it allows me to pay less out of pocket for the shares. Today, I receive $93.34 up front. That money is mine to keep no matter what else happens. And if I'm assigned to buy the shares, I will have received $93.34 and paid $7,000. So my total out-of-pocket cost will be $6,906.66. That makes my out-of-pocket cost $69.06 or 7 cents per share. I will be in much better shape than I would be buying the shares outright today and paying $7,045 for them. And if the contract expires worthless, I can just sell another put and bring in some more cash. In exchange for my agreement to buy the shares, I collected a premium of $94. That money hit my account immediately, and it's mine to keep whether I end up buying the shares or not. If the share price stays above the strike, the put expires worthless. I keep the cash and never buy the shares. If the share price drops below the strike, I'm assigned to buy 100 shares at a price I have chosen. I still keep the premium, so my real investment price is even lower. And remember, I only do this on stocks or ETFs that I would be happy to own in my portfolio. That's why this is my go-to strategy for consistent income and long-term investing. Options trading doesn't have to be risky when you choose strategies that start with good risk management. If you can understand your max cost, be happy with the outcome either way, and get paid up front, you are already way ahead of the game. I walk through cash-secured puts, covered calls, and how to manage risk and outcomes step by step in my ebook, Beginner's Guide to Safe Options Trading. It's written for real people, not day traders, and it's full of real-life examples like the one I just showed you. It's not quite explain it like I'm 5, but it is an easy read with plenty of links, simple language, and illustrations to help you follow along. It's $4.99 at Amazon, and the link's in the description. Thanks for watching. If you're ready to trade with your eyes open, not crossed fingers, hit like and subscribe. I've got more beginner-friendly trades coming soon.